In times of crisis, gold becomes more than just a metal. Explore why investors rush to gold when markets shake. Uncover trading secrets from a veteran of a gold desk. What's myth? What's a market? And what's coming next? My name is Adrien Biondi, and this is Spot the Forward.
Welcome to the new episode of LFMA Spot and Forward, where we uncover the gold trading with insights from a market insider. Whether you're a seasoned investor or just curious about how gold moved the global markets, LFMA is happy to offer you this front row seat for real insider knowledge. For this, I'm glad to have Adrien Biondi, General Manager of GFI Gold, with me.
Thank you very much, Miao. I'm very glad to be here and with LFMA. Thanks for inviting me.
Thank you. Well, let's start with some basics. I am personally a gold lover, and I believe for many people, gold is a symbol of wealth. But I think it's more than just a shiny metal, right? Adrien,
Yes.
Can you tell us what gold is in the financial market?
Oh, gold, yes. Gold, but look at this way. Gold has been an investment vehicle since mankind. And gold is a reserve for central banks. You know that. Gold is a way of saving money. Gold is in many cultures something which you must have. And if you look back in history and now, well, it was always a vehicle where people was just store their wealth. But investments in period of crisis, in periods where the markets are not so sure, where you have crisis, financial crisis, economic crisis, geopolitical crisis, we see it now in various areas in the world. Gold comes in as an investment, or at least a safekeeping of your capital, of your wealth.
Adrien, can you tell us what drives the gold price?
So first of all, gold is what people don't realize. Gold is a commodity and a currency. Gold is a unique material which cannot be destroyed. It's always fully recoverable. It's scarce, so resources are limited. They reckon that about 220,000 tons have been mined since mankind, and about 50 to 60,000 tons are still available in the grounds. Having said this, not all gold can be mined. Some of the gold may lay under cities. One example I have is under Cologne. Cologne, there is gold. People talk about the Rheingold. I'm sure the Rhine was bringing gold everywhere, but under Cologne they have found gold, but they cannot mine underneath Cologne. And the tenor is sometimes so low that it's not even worth mining the gold. On the other hand, having prices around 3,500 at the moment, for various reasons, discussion of mining takes a different stance. Why? Because mining companies have costs to produce, cash costs, and underneath a certain price they cannot mine. And this has now generated demands, but also when you look at it, the higher prices have given mines a possibility to mine a material which was not even interesting before. Also, another fact in this market is that 50% of the market is jewelry still, and the other 50% is divided between industrial demands, electronics. I always think computer electronics, circuits, all the stamp circuits, and bar hoarding from central banks, institutional bar hoarding, central banks, insurance companies, funds, and private investment. Generally, in calm and steady markets, investors tend to invest into gold as a portfolio diversification. Why? As gold doesn't produce any interests in a physical form, the demand is rather low in times where the market is calm and the demand doesn't come out of a financial crisis or economic crisis. With low prices, demand is driven more by the physical demand for jewelry. Jewelry is more in demand when the prices are low. Think of India, think of China, think of all the markets of Turkey as well. I think of all the markets where jewelry is still a big part. In countries like India or Vietnam or Thailand, even China, yes, you have I saw the Middle East. Sorry, I forgot the Middle East. It's a vehicle of saving money, is a vehicle to store wealth and capitalize the asset. In jittery markets, although, when markets, as I said before, are negative, markets are, you have crisis in financial crisis, economic crisis, geopolitical crisis, which we see everywhere happening at the moment, gold becomes a safe haven investment. Gold demand is driven by investors who want to get out of the currency risk or get out of their stocks and bonds position. The investment is not sure. They want to park their money. I'm saying parking. Why? Because they want to keep their assets or their capital, and the best of times make money out of it. Gold is a great asset to raise inflation or in and eroding currency. I have an example. In 1920, 5 kilos would buy you a house. In 2025, 5 kilo will still buy you a house. Maybe not in Luxembourg, but everywhere else in Europe it does. The latest high in gold prices is due actually also to the devalorization of the US dollar. Dollar has always been also a safe haven, which was in competition with gold. But lately, the dollar, because of the high debt, because of what's going on in the US at the moment, it's losing its place and the policies of the governments, of the reserve banks, of the central banks we have in the world, are switching. Not all of them, but they are looking at gold as a reserve asset.
Well, thinking of commodity, there's always a natural link with industrial use. However, unlike the other metal or oil, who seem to flourish in booming economy, gold tend to shine shinier at less favorable economic conditions. Could you tell us why?
Gold compared to other commodities, even precious metals, like silver, platinum, palladium, rhodium, ruthenium, people don't even know what that is, but gold is mainly a safe haven investment, where other commodities or other precious metals is not only but mainly driven by industrial demand. These the white metals, we call them white metals, platinum, palladium, silver. They are doing well, yes, because of investments. But if you look at them, 90% of the demand is pure industrial. Gold is a crisis investment. Geopolitical, as I said, geopolitical, economic, financial, whereas other commodities are always bullish and bullish markets with high industrial demand. When the industry is doing fine, silver, platinum, palladium are going up, gold less. That reverses when there is a crisis in whatever domain. Stocks will appreciate, and gold will lose its lackluster when the economy is doing fine. Demand for commodities will rise in a good commodity. In a good environment. One very important point for gold is that gold is also considered a currency. Many people don't see it because the currency is because gold gets traded against dollars or against euros, so it is always quoted in the trading floors, XAU equals. So it's also a currency for many. Although many central banks also don't forget, the only difference between the FX market and the gold market is many central banks own gold in their reserves, but no central bank regulates the gold market. Everybody has gold in their thing, but nobody is there to regulate the market. Gold, compared to other currencies, cannot be printed or multiplied like currencies. When lending gold, well, you actually need to deliver the gold. You cannot say like, okay, I send you something on the account, but if you have to deliver the gold. You have to own the gold. When physical demand is high and stocks gets scarce, local London or wherever the clearing happens, because you have clearing in London, you have clearing in Zurich, which is getting smaller, but also you have some clearing in the COMEX and NYMEX in New York. Interest rates for gold move higher because there's higher demand and there's less physical around. The same happens with the EFP, exchange for physical, which is the difference between the gold future contract and the physical gold. Note that gold futures are also derivative futures compared to the dollars, or I mean to currencies. Actually, the people who own the future and they are long the future, they will get at the end delivery.
Now that you've mentioned that gold is both a commodity and a currency, could you tell us where are the main markets to trade gold?
There's a big OTC over-the-counter market. I don't need to tell you that for professionals, but maybe those who are watching who are not really into this business. And this OTC market is located in London. The XAU equals what you see on the trading platforms or on information systems is 1 ounce of pure gold, local London. Any price derivation of this XAU equals price is a markup or a discount for different locations or purity or forms of the gold. Local London means a standard bar of minimum 995 parts of 1,000, weighing between 360 and 400 ounces. Why so precise? Why so random? Well, a century ago, when these parameters were set, technology was not so advanced as today, but the standards were set, and the bars needed to have a minimum of 995 parts of 1,000, and the bar weighing around 800 ounces. I can assure you today, with the technology we have, all bars are around or precisely 400 ounces. In the US, the futures market is predominant compared to London. The market trades lots of 100 ounces. One lot traded in the COMEX NYMEX or the CBOT is 100 ounces for gold, and their bars correspond exactly to 100 ounces, with a tolerance of 5%. Actually, also a minimum of 995 parts of thousands. Although now the CME, CBOT, or the COMEX, NYMEX, call it as you want, because they're all now together, accepts lots of 3 kilos of gold, which is almost 100 ounces, or they also accept 400 ounce standard bars. The futures market will trade mainly April, June, August, and December. Why only the four contracts? Why? Because you cannot trade everywhere, all of them, and it has a routine which has been set for the last 30, 40 years. The difference between the future price and the UTC price is called EFP, as I said before, and the UTC price plus it's nothing else than the OTC price plus the forward to the maturity date of the future. Asian markets have the tendency to trade on margining accounts, which is basically the same like trading futures, but they don't have a defined maturity. They just keep making sure that they have enough margin on their accounts to cover the open position until they decide to close it. As mentioned earlier, there is an OTC market in London based on physical gold. Actually, the OTC market is the XAU equals represent 1 ounce of gold or physical gold in London. And there are 5 clearing members, 5 banks, we call them bullion banks, located in London, who do the clearing, and they have warehouses in London. The Bank of England also stores gold, but they store mainly for themselves, for the central bank, for other central banks in the world, and some commercial banks who need to get the gold from the central banks when they get the loan. The easiest way to invest into gold, to own ounces is to own ounces on accounts. sorry. The easiest way to invest in gold is to own ounces on account in a bank. XAU equals local London is the easiest. The form of investment is easy and bears the least costs as in the physical gold market, which we have here in the GFI, for instance, coins and bars. Why? Investors do not want to go through the problems. Investors who do not want to go through banks or want to have direct access to their gold holdings invest in bars and coins. There's a big market offering bars from 1 gram to 1 kilo, of course, also for 100-ounce bars, but they cost a lot, so they are difficult to store. And various coins. We have also various coins, bullion coins, from 1 ounce, half an ounce, quarter of an ounce, and tenth of an ounce, where people invest. Generally, in times of disinvestment of stock exchanges or loss in trust of Western system, demand for physical gold goes up. Entities like GFI come into the picture to deliver this service to the customers.
And who are the major market players?
As gold is also a commodity, and mainly commodity, there are several players in the market to make gold trading possible. The interference of these players are the market. Mines mine the gold, refiners refine the extracted gold, banks and trading houses which finance the processes and make the gold accessible to end consumer, which can be jewelers, manufacturing industry, investments like funds, central banks, private individual, and all this is made possible shipping agents, which transport the gold from the mine to the refinery, from the refinery to various locations, warehouses, which belong to the various players in the markets, like exchanges, banks, trading houses, and coin and bar traders like us. Recyclers also have a big part in the whole process. Recyclers understood almost like miners, which deliver the metal to the refinery. They get the metal back in the system, and they make bars and coins, which will be accessible to the investor. Each player offers a variety of products, which can be physical of accounts or even indexed on the price of gold. Banks specialize in gold trading. Banks specialize in gold bullion banks offer the biggest variety of products, as they have the licenses and the capital needed to run these operations. Physical gold markets is, for the last 2 decades, actually shifting more and more from banks to bar and coin traders, as the latter have specialized in the physical product. We at GFI serve B2C for private banks, for funds, or even family offices, and B2B, of course, individuals who want to invest gold, for instance.
We're experiencing quite a lot of volatilities in financial market overall. Could you tell us how geopolitical uncertainties impact gold markets?
A lot. As I mentioned before, gold is a crisis investment. Not only, but it is. Certainly, uncertainty drives a lot of investors to gold. One example, the Great Depression, for instance, when stocks plummeted, the currencies depreciated so heavy that only those who owned a piece of gold were able to survive. Think of Germany. The fear that fear has been embedded for a long time in people's minds, especially as older generations, since the war, which started, and which now, since 2025, these fears came somehow back. They have been revived. It has started with the Russian-Ukrainian conflict, before the Middle East conflicts, tariff wars, and exchanges started correcting. People got scared. US-dominated bonds and US dollars itself lost more and more the dominance of the market, and investors are turning slowly or surely to gold.
Given gold's reputation as a good store of value, do central banks also play a role in gold trading?
Over time, I noticed central banks are counter-cyclical. Why? I'll tell you. When gold markets correct, central banks tend to sell their gold. Think of the UK, think of Switzerland. And when the market edges higher, they seem to buy gold. They start building the reserves again. We see that at the moment. China, Poland, India, they are buying gold again. Another fact is that central banks have found a way to exit certain currencies and bonds by buying gold at the moment. Central banks with low reserves in gold have also changed their policy over the years. Since the end of the geopolitical issues have increased in the past 10 to 15 years, it resulted as a game changer for central banks.
Gold trading isn't just risk-free, right? What would you see as primary risk associated to gold trading?
I think the biggest risk is actually access to trading, owning the gold and storing it. These are the main factors actually which makes it difficult. Moreover, many forget that the gold market is compared to an FX market rather small. When a bigger player liquidates a position or enters a position, it moves the market much stronger than other markets. The volatility is really, really high. Adding to this, many people forget that gold is a commodity. The price does not get regulated by central banks, as I said before. When there is a shortage, price will rise, sometimes heavily. Miners may increase production. Recyclers will get the metal back from various players, which will in the end increase stocks and stabilize prices. I want also to add that within the gold market, there are indeed some dishonest players which try to con players, which falls. But there's a whole aura about golds, and it's often driven by sensationalism. Other markets have many more scandals, but gold has always this aura of there's something going on. In general opinion, often is more receptive actually to these stories and about gold than other markets. There has also, but I must say, there's been a great work done by the LBMA, London Bullion Market Association, the World Jewelry Council, and other regulators like FCA, REACH, CFTC, SEC, to name a few, to erase this first the bad players, but also this negative aura surrounding the gold market.
Thank you, Adrien Biondi, for sharing this insightful information with us today. Dear audience, thank you for tuning in. If you find this episode interesting, there will be 2 more sessions where we'll uncover the trading strategy and the future of gold markets. See you next time at LFMA Spot and Forward.
Thank you, Miao. Thanks for having here. Thanks to LFMA, and please stay tuned for the second episode of Spot and Forwards.